Welcome everybody. My name is Stefan Friedrichowski, and it's a pleasure for me to have you once again here in that webinar series about developing superb trading strategies. Just for the minutes, we have today the 21st of July, 11 o'clock, at least in Germany, it's 11 a.m. and we have 2016. But that's only for the recordings. I hope you can hear me and you can see my screen with the slides on top of my screen. So the topics for today are quite easy. We have first of all to do the last step from last week webinar about principal guideline of stop-loss settings. I will introduce the ATR. This is not a new indicator. I assume everybody of you knows that indicator, but I will show how to calculate ATR even in an Excel sheet so that you all are prepared when you do something in Excel for strategy development, that you can calculate that indicator in Excel as well. It's quite useful, and you will show the result. I will show the results in a few minutes. Other topics for today is first of all the importance of spread. As I mentioned earlier already, the spread is quite important for all our trading activities. So we have to first to monitor the spreads at the broker of our choice, and of course we have to look into what spread behavior we have over the time, so that we can use the appropriate spread values for our trading strategies. That is, by the way, one of the most common mistakes people do, because they use too low spread values. Then I want to go further into what are the typical movements in our markets, especially in forward markets, because we have to realize on what time frame we can have what typical movement. This is once again something which has to do with stop-loss settings based on the time scale we want to trade. There are people maybe on M5, people doing D1 or even weekly trades. There's a big difference, and I can show you how to calculate those typical movements, which has an impact on our trading behavior. And last, I want to combine those tools a little bit. So the typical spread versus the movement, that is quite interesting, because then we can set up our favorite trading candidates. So which underlyings might be most profitable in terms of exactly that combination, the spread value and the typical movement. And therefore, having both numbers, we can really identify our favorites. As always, whenever you have a question, just use the chat and question functionality of your user panel of the software, and you can ask me directly any question. I try to answer them online, and if it's a more general question, then I will answer the question more at the end of the webinar. As a remark, when you have specific questions, you want to have those slides, whatever documents I show, just send me an email, and I will make sure that you get them as soon as possible. Another remark, as always, I have to show or to guide you to the bottom of my first slide. There's a risk warning. All of you know that whenever you trade, you should know the risk involved, and you trade always on your own. But that's all as an introduction. Let's move into what I promised already last week, that we have to consider the so-called ATR. ATR stands for Average True Range, and that is something which measures the volatility of a market and we on a certain time scale, and everybody knows in the MT4 how to use that indicator, but maybe you are not familiar with the fact how to calculate it for your own. So what I have here, for example, in my chart, I have an ATR here in the button of my screen. In this case, it's a euro-US dollar on an M5 base, and we can see over the night volatility goes down, and with the beginning of the market opening in Europe and then further in England, volatility goes up, and that is something quite typically. But how to calculate the ATR? I showed already last week. There is a link to a Wikipedia page where you can see all the details, but I will show it to you just in an Excel sheet, because then you can do it by your own whenever you need something like that. Based, I can zoom a little bit, then it's easier for you to follow. Last week I showed you how to get access to data, historical data, and this is exactly what we get when we, for example, download those data from Dukascopy. And now I want to calculate the so-called average true range within that Excel sheet. Let's have a look here to that cell. What does it mean? In this cell, I simply get the maximum of all possible combinations which might enter into the ATR. The first part, E5 minus F5, is simply the difference between maximum and minimum of my candle, and it is normally the range of a candle, normally. But in this case, if we have a gap between the last candle and the current candle, then we do our calculation based on the close of the last candle. If you, for example, think about indices like, for example, DAX, then of course you have gaps within your chart, and then it would be misleading to only use the difference between high and low of a certain candle. Therefore, it is needed to have the close of the last candle in the calculation as well. Therefore, we have this maximum between high and low, or the absolute value between high and close of last candle, and the absolute value between low and close of last candle. And exactly that is a number we want to have as the true range. And just for simplification, because in the first candle I don't have a close value of the previous candle, I use the difference between high and low. So, and then we can have it all over our candles. And then what I personally do, and that is different from what you see in the MT4 indicator, I use the percentage value of that ATR, because at least when I move to indices, DAX has been at 1,000 points, is now at 10,000. The absolute value doesn't tell you that much, so we have to do it percentage-wise based on the close value, for example, but it's not. You can use the high or low. That doesn't change the numbers very much. So that is a percentage true range. So that number tells us a lot, because it shows us the typical candle difference between high and low. And then what we do is, let me switch here first. I go a little bit downwards. What we simply do is, in the indicator language, one would call it an SMA, a single moving, a simple moving average. So we calculate simply the average over the last couple of candles. And in my case, I do the averaging over 24 candles, and therefore I called that column ATR24. So we have this average value here as well, and I have done a second ATR that is based on 120 candles, just for illustration what kind of difference we get when we have a different averaging of those values. So let's have a look to the chart. I have here the data H1 based, so hourly based, from euro US dollar for 2016, and within the graph you have the date and the percentage ATR, with the two ATRs, one the ATR 24 and the other one ATR 120. What about those numbers? Just very simple. ATR 24 because that is exactly 1 day, so 24 hours is 1 day, and ATR 120 is exactly 1 week. So quite easy. And what you can see, of course, the ATR 24 is a little bit more tricky, goes up and down just because of the shorter period, but the typical value of the ATR itself, that is more or less the same. So if you compare the red curve to the blue curve, you see that the number itself goes during the first month down, 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 down. So the volatility was decreasing, and then all of a sudden, already before the Brexit decision of England, that is exactly the big peak within the chart, that is the Brexit time, then the volatility went upwards and went down once again. So why do I compare those two ATR values, or those two periods? Simply because I want to show you what I mean when I say we have a weak indicator. With weak indicator, I always mean that does not depend that much from the period. For example, the EMA is different. If you have different EMAs within your chart, and you would use an EMA 24 and an EMA 120, you would have a huge difference. In this case, we have temporarily huge difference as well, but in average, it's more or less the same. Therefore, I call that kind of indicator weak, because when we further go to trading strategies, you will realize that whenever we use the ATR within our trading strategy, that the ATR period does not have that much impact on our trading strategy. Just beside some small events, small in time, so the duration of that peak is always quite short, but the absolute value is not changing that much. So what does it mean for trading? Those values like percentage of 0.2 is already a good indicator when setting a stop loss. So using the ATR in absolute values or even in percentage values would help you to have a good stop loss level. But what I use finally, and that is what I showed you here in my slide already, what I typically use is the so-called multiplier, a fixed multiplier on that ATR value. So multiplier of an ATR value would mean if we have typical ATR of, for example, 0.2%, and I have a fixed multiplier of 3, I would apply a stop loss of 0.6% for my trading. And that kind of parameter, that multiplier to the ATR, is then a typical parameter entering in all my trading strategies. So I don't use an absolute number of bips. I don't use an absolute number of percentage value. What I use is a multiplier on that ATR, and that enters into my trading strategies and is 1 degree of freedom, that multiplier, when we finally come to real trading strategies. So that has to be optimized, and the ATR period, as already said, is a weak indicator, so that means I fix it, and typically I use either 24 or 120, depending on the kind of strategy. If it's a strategy totally intraday, then it's the 24, and if it's a strategy which goes with trades overnight, then typically I use 120. Okay, that was the story about ATR entering into our trading strategies. And let's move to the next topic. And the next topic is about spreads. The importance of spreads mentioned already a little bit earlier is quite simple, because we have always to pay the spread for every trade. There's nothing to blame a broker, because it's related to the market. We have a difference between ask and bid prices, and immediately after entering a trade, we are in the minus, and that we should have always in the back of our head. Everybody of us knows that we have from time to time what is called a spread widening, and this spread widening occurs typically around news, for example, whether it's an interest decision of federal banks, whatever, or what we can realize as well is around midnight we have always that kind of spread widening. Why is that in that way? Simple answer, the spread itself is, let's call it a measure of the liquidity within the market. And with less liquidity, the spread goes up. And therefore, around midnight, for example, we have less liquidity and the spread goes up. What is important for us, looking for trades and really to consider the importance of the spread, is that this spread widening can kick us out of the trade, so to speak. Whenever you realize, or if you look to trades around midnight, for example, you might see, hey, why is that trade closed? I can't see that my stop loss has been reached, but it's simply because of spread widening. So we have to deal with that, and therefore we have to know exactly about the numbers involved. Keep in mind the spread is always against you, so therefore we have to look into that in detail. So now to the question, how do I personally calculate or look to spreads, because those spreads have to enter in my trading strategies as well. And what I do is the following procedure. First, I have something like you see now here on the screen. That means I have a couple of underlyings running on an M5 chart, and you see for all the underlyings the spread monitoring. So we have all the numbers here with the current spread, for example. Out of that current spread, we can have a look, for example, to this chart, and you always see, if I look, for example, here, if I put the cursor across here, then you realize, okay, around midnight, spread values go up and even sometimes exceed enormous values. So in this case, let me have a look. It's going up to 10 bips, which is really a lot for euro US dollar. But we know that kind of behavior and we monitor that kind of behavior. Monitoring means all those numbers are stored and can be analyzed afterwards. So that is exactly what I personally do. And then I have a certain criteria of what I call a typical spread. And of course, you can already imagine that my typical spread for euro US dollar would not be something here in that range of 1 bip. Of course, the broker offers me a typical spread. Right now we have 0.76 and so on and so on. But that is not the number which should enter into my trading activities. So how do I do it? First of all, I take those numbers from that spread monitoring, and then I feed those numbers in an Excel sheet once again. And just as an example, oh no, I switched to US dollar, Japanese yen. Then you can see how I personally calculate those values which go finally into the trading strategies. For example, here I have those numbers. For every minute I have 3 values, the maximum spread within that minute, the average spread within that minute, and the minimum spread within that minute. And a typical chart looks like previously, so we have always around midnight those peaks, and we have the 3 values, maximum, average, and minimum values. So what I do then is simply I do what is called a histogram. A histogram only or is needed that you have a distribution of your spreads. And what I have here is the histogram of the average spread. So in most cases, so around, let's say, for example, here at my cursor position, we have the 95% value. So in 90% of all times over the day, I have spreads less, how I go down, of less than 1.2. So that is a 95% criteria. Some people call it so-called quantile, but that doesn't matter. So what I do is such a histogram, calculation of that kind of histogram, and then look for the value at 90%, 95%. But I personally do not go for the average value, because I mentioned already the sentence, the spread might kick you out of a trade. And that happens already with the maximum value. So it might be only one time that you have huge spreads, but even that one time can kick you out of the trade. Therefore, I do that kind of calculation for the maximum spread and not the average spread. Once again, I look for the 95% criteria, and going a little bit here to the right, then I see, okay, for this underlying US dollar Japanese yen, it's a 1.6 bips, and that is exactly the value I use for trading. For that underlying, so not using for trading. Trading is done with real spreads, but for calculation of trading strategies, I have to enter spread values, and in this case, for dollar Japanese yen, I would use a 1.6%, because then I know that in 90%, 95% of the time I have values lower. Let's have a look what that means. 1.6 for the underlying. I go back to the spread monitoring and looking for this behavior. Then a 1.6, and let me have the cross here. Then we see what does it mean. A 1.6 is around here. So there we would have the 95% criteria. Still, you see that there are a few times when we have higher spreads, but I don't want to have it too worst case, so that is a number in this case I would use. I have prepared for you, and I repeat myself now, if you are interested in those values derived from those histograms and the 95% criteria, then I have a sheet here, and you can have it if you want. For all the 21 underlyings I always been interested in. So for that are my favorites in general for looking for Forex trades, those 21 underlyings, and I'll tell you in a minute why those 21. And all those numbers here in absolute values or in bips are those values I use for trading strategies, optimizing, calculating, backtesting, and so on and so on. So I use rather huge values for spreads, and simple reason, I don't want to lie myself. That is something I have often seen at many people, that they use very small values for spreads. So they only look for typical values, and if you would look for a typical value, for example, for euro, US dollar, then you would not have a 1.6, then you might have numbers of 0.2 even, but then you get misleading results out of your trading strategies. Those numbers have a huge impact on the performance of any trading strategy. I will show that within that webinar series, what is the real impact of a trading strategy and why it's that important to use those high numbers. And if we have let's call them a strange forex pairs like British pound, Canadian dollar, then yeah, a 6.9 might look very high, but it's the appropriate number for that underlying. So it's important to use those values. I still have not answered the question why those 21 underlyings. They don't fall from heaven. It's but it's quite a simple story. Just that in between, let me have a look. I have here a Wikipedia page of foreign exchange markets, and if you scroll down a little bit on that page, then you can, that's by the way important as well, or interesting as well. Who are the biggest player within the Forex market? You can see Citibank, JP Morgan, UBS, then Deutsche Bank, and so on and so on. But that's not the way how I get my 21 Forex pairs. It's exactly that kind of table which drives my selection to those 21 Forex pairs. And what you have here is the ranking of the major currencies. Major currencies in a way of how much is traded of a specific currency. And of course, number one is the US dollar with a very huge amount of nearly 90%, followed by the euro. Don't wonder that the number does not add up to 100, because you always need two pairs or two currencies if you want to have a trade. And what I have done here is simply I use the first 7 of that ranking, so down to Canadian dollar. So I have 7 base currencies, and out of those 7 base currencies, you can mix up 21 Forex pairs, because we don't count them double. We have only euro, US dollar, and not vice versa, US dollar, euro. But then it's the sum of 6 plus 5 plus 4 plus and so on and so on. So therefore, I always look to those 21 Forex pairs, the major 7 currencies we have within the market at all. I could go down, but at least if I would go to the Chinese yuan, then other questions would pick up. And but so that is my selection, and therefore I always look to 21 Forex pairs. So we now know the typical spread value of those 21, which is already really important to know. The next question is, what is a typical movement of an underlying? What is a typical movement within the certain time scale? So what can we expect if we would wait 10 minutes, 15 minutes, 1 hour, 1 day? So the question is simply, what kind of movement do we have? And you may already ask yourself, hey, does that have an impact on my trading if I have an underlying with a typical small movement, or with a high movement? High means high percentage change of the price. So how can we get those numbers? That is now something I will not show via Excel. You can do it with Excel as well. But since I really want to have data from the 5-minute upwards, then the number of historical data is that huge that we need, or you can not still live with Excel. Therefore, I do those kind of calculations in a small C program, just that you have an idea of how something look like this. That is a complete program for the calculation I will show you, or I will show you the results. So what I do here within that small C program, which is really easy to write, if you have the data, then you can do such a program by your own. And also that will be one of the upcoming topics for those webinar series here. But this calculation, how is it done? Let me show you this via just the graph itself. So we have here the price change on an M5 base of euro US dollar, for example. And when I now call something a typical movement, I ask myself, and I always, in this case, I go down I go to the history, but it doesn't matter in which direction I go. So I have a close value of that candle, for example, here. And then I ask, okay, what change in percentage do I have within the last 5 minutes? So that would be exactly the difference between the close from the previous candle to the close of that current candle. So that would be the change of 5 minutes. And I can do that kind of calculation all over the last, for example, 10 years. Next question, what about looking for 10 minutes? So I now look for the percentage difference between that close value and the close value from the previous candle. So that would be here. And that gives me a number for a 10-minute movement. And you have to average over those values as well. So all is done by averaging, and since finally in this case we don't care about the direction of the movement, we use the absolute values of those changes, because the question is, what typical movement do we have on a certain time frame? And time frame then means I always double them. So I look for 5 minutes, 10 minutes, 20 minutes, 40 minutes, 80 minutes, and so on, and so on, and so on. Because then I have a clear indication of on which time scale I do have what kind of movement in average. Let's look to the results of that kind of analysis. And that kind of analysis I have done for all those 21 Forex pairs. And once again, we have those 24 Forex pairs here. And let me enlarge here. So what else numbers do I have within that Excel sheet? I have the average all. That number is only calculated so that we can translate percentage values later in absolute values. This, by the way, is the average of that underlying over 12 years M5 data. So it's, by the way, 800,000 candles. And now, since hours might be a little bit more telling you than minutes, I translated the minutes. The first one is 5 minutes and so on. Then we have here nearly 1 hour. And the last one, 341 hours, that is about 14 days. So what we have within one line here is the average percentage change of our underlying after 5 minutes, 10 minutes, and so on and so on. How does that look like if we plot a chart? So a chart of that would look like this for the different underlyings. And what you can see here, once again, the x-axis are hours, the y-axis is percentage, so a 3 really means 3%, so 0.03. And this kind of curve is telling you much more than you would expect on the first hand. Let's look for the first one. By the way, the highest one is Australian dollar, Japanese yen. So we have this kind of typical movement after a certain time scale. So what we see is on a short time scale, we have higher movements compared to the time after, for example, 14 days. So we have not a linear behavior, we have a more square root behavior in this case. So that tells you if you trade on short time intervals, you can expect percentage-wise higher movements than after, for example, 14 days. And what you see as well is that the underlyings are behaving quite different. So in order to get them sorted, I do it here online, and I quickly sort them to the value of 14 days. And then we have this kind of chart. And you can see that the one with the lowest percentage movement is Euro British pound, which is the lower one here. And the one with the highest percentage movement is Australian dollar, Japanese yen. I'm not sure whether you would have expected that kind of result. It's really strange, at least for me, because I would personally not have expected that the Euro British pound is, let's call it, that slow, and that especially Australian dollar versus Japanese yen has the highest movement of all the 21 underlyings. So that tells us, okay, if we want strong movements, we should prefer Australian dollar versus Japanese yen, because then we have the highest value of movement at all. So movement means in whatever direction, but it's a high movement. So we have strong moves. I can expect big ranges. And now it depends on the strategy itself, whether that is good or bad for you, for that kind of trading strategies. But at least we know now what underlying has what typical movement. And one question here is, maybe somebody of you knows that already, because now I will change the axis to a logarithmic scale, and I have to do it for both. And strange enough, we have a clear observation in a minute. In a double logarithmic scale, you see straight lines for all the underlyings, absolutely straight lines. And the question is now, does it tell us something? And what is the so-called exponent of that behavior? So I would insert a trend line, but now I use so-called power, which means, for example, A times X power to B. And let's have a look to the equation. And maybe you know already the answer of what slope do we have within that double logarithmic plot. And you see here the slope, that is the exponent of that formula, and this exponent is quite close to 0.5. Does it mean anything? Clear answer, yes, a lot. That's really a lot. What that number is telling us, that we have a more or less a square root behavior of typical movement versus time scale, that is the square root, is telling us that most of the time all the movements are randomly. Because if we would dig deeper into that kind of subject, that is the so-called random walk world, then we will realize that this is a typical exponent of something which changes randomly. So it's like if you always throw a coin, do I go one step further or one step back? And then you look for your history of all your movements, then you would get quite a similar behavior, and it would be exactly 0.5 in this kind of exponent. So it's interesting to have, I don't want to call it a proof, but it shows you, hey, trading is difficult because we have to deal with randomness. And what we can see here within that double logarithmic plot now is, of course, the highest value is still Australian dollar versus Japanese yen, but the overall time behavior is the same for all the underlyings. If I would add some indices here, it would change the picture a little bit, and a simple reason, because, for example, looking to 10 years of DAX history or S&P 500, we all know, of course, there is a favored direction, mainly higher, 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 and that would have an impact on that graph as well. But that's something for later. So we see a small hint for the randomness within all our underlyings. But once again, to what we concluded already, there are favorites with stronger movements, and those the list we have here, and the smallest movements we have in Euro, British Pound, Euro, Switzerland, and so on and so on, and then it goes up to Australian dollar, Japanese yen. So that's quite interesting. By the way, for example, the main currency pair is exactly more or less in the middle of all those underlyings. So interesting behavior. And now we can do something. We can combine the two results. So remember my sentence that I always say we have first to earn the spread in order to get a profitable trading strategy. So now we have two components or two integrants. We have the typical movement, and we know the typical spread of an underlying. Yeah, what's better than to combine those two results? So let's go back to my spread sheet here with a table of all the spread values. And what I have done now is simply I go directly to the final result. What I have done here is I have calculated all the percentage movements into absolutely movements, so absolute movements in terms of that specific underlyings, and then I have divided that number by the typical spread, because we have to earn the typical spread first in order to get a profitable trading strategy. So still we have the same kind of behavior, and double logarithmic plot would show you once again the 0.5 exponent. But now it's interesting to see this list sorted once again to what is trade best, or where can we have best results in terms of combination of what is a typical movement divided by the spread, because that spread we have to earn first. And now the situation changes a little bit. That means now the favorite of all is Euro US dollar in terms of to earn the spread the fastest. And then we have this Euro US dollar being the top one. So after 14 days, typically we have a movement of nearly 200 times that kind of spread value. So you can see that one would be an underlying really my favorite, and therefore I concentrate in most cases whenever I have a new strategy or an idea for a new strategy, then I focus first on Euro US dollar. Okay, Euro US dollar would be a currency pair maybe of everybody, but let's go down the list. Australian dollar, US dollar might not be my second choice just out of my head. And go the list down, then you find once again big majors. And by the way, this what calling a currency a major currency, you can see here in that sorted list once again. It is more or less a list of the major currencies, and going upwards, then you come to other currency pairs which are not that popular and not to be traded that easy as others. So this combination of typical movement and typical spread is a very good indicator of what kind of underlying we should choose first whenever we look to a trading strategy. And even not only that, you can also use that kind of information for your normal trading activities beyond any automatic trading. So that would be the list of favorites whenever you enter trades. To be a little bit, let's call it, easier to get profitable than compared to other underlyings. So this is quite a cool list, and I showed you within the webinar how to derive it really mathematically out of all the informations we have. There's still one final step, and that is something we do online within the developing of all the trading strategies. That is now the combination to ATR, because that is not absolutely the same value than the typical movement on a certain time scale, but it's something into that direction. Finally, I can tell you already that does not change that list, but in the trading activities, we have to use all those information, ATR values, typical spreads, and typical movements. So that's valuable information for developing trading strategies, and that is, of course, we continue that next week. And I can tell you then we will, for the first time, change to an indice. That means we go to in this case for the DAX, and show how can we derive, quite simple, a complete DAX strategy, which is already capable to be traded even manually. And then we want to discuss a little bit more on how to optimize and how to avoid over optimization, which is very crucial whenever you develop trading strategies. Let's go to my slides, because I still would like to welcome you to just get in contact with me. You know that I want to change the behavior of that webinar slowly to a more interacting webinar series, just to have your specific inputs on trading strategies, on trading activities within that webinar series. So there have already been a few people writing me some emails, looking for other data sources for historical data, and so on and so on. So that was already quite interesting to get your input there as well. And I want to repeat my offer that whenever you have questions, just get in contact with me. Also, I want to say thank you to Argus FX that they enable us all to have that webinar series. So many thanks to Argus FX as well. So, and whenever you want to open an account at Argus, you can follow those links, and you can go to trading strategies running on the Argonaut platform on Argus FX as well, which is quite a cool platform to follow other people trades. Okay, that's for now. Today, 5 minutes earlier than expected. It's hard to estimate exactly how long it will take within that webinar. But nevertheless, I hope once again that you get valuable information for your trading activities, for your developing of trading strategies, and that is the next thing. that we all do at one example, how a complete strategy is derived following all the basics we have introduced up to now, and that will be done next week, same time, at 11 on Thursday. Okay, that's for me. Thank you very much, and have a good time. Bye-bye.